been a bit of a ride in the stock market the last few days, and they've pretty much wiped out all the post-election gains. Question now that's most relevant, is this just the beginning? Hello, my name is Paul Carroll. I'm the CEO and founder of Avion Wealth, an elite wealth management firm based here in Texas. Now, most recent figures that came out show annual inflation dropped to about 2.8%, and that's pretty good news because when inflation drops, it gives the Fed wiggle room to lower interest rates, which is pretty much going to have to do at some point in the future when the economy turns down, not the market. There's a lot of academic research. It goes back literally over 100 years, and we've talked about it. Jobs saved by tariffs tend to be very expensive. Studies show that, especially with targeted industries like, say, the steel industry, every single job saved costs about 10 times what that person was paid in terms of higher prices and costs for consumers. So I think the average is about $680,000. We would, as an economy, be better off getting rid of the tariffs, raising taxes a little bit, and just writing these steel workers checks for $500,000 a person. That's how expensive this is going to be. The tax impact of tariffs on the average household, again, feeding through higher prices and slower economic activity, is going to be in excess of $1,000. Growth is expected to drop by 0.5% or even more. And in a large country like the United States, that's a major portion of the 2.5–3% GDP growth that we look for each year. Job losses, according to some studies, will be as much as 500,000 people. I remember when I came to this United States, early 80s, domestic cars made by Chrysler, Ford, General Motors, were pretty much considered to be junk compared to cars anywhere else. And that was in no small part because of protective tariffs and protected markets. When markets are protected, companies get fat and lazy. They get inefficient, their quality drops. And it makes it very hard for them to compete on a global scale. We got rid of those tariffs, we got rid of a lot of those protections, and we saw the industry almost get wiped out. And it did survive. There were some huge bailouts, most famously for Chrysler, but it did survive. And today, cars made by Ford and General Motors are competitive on the global marketplace. They're mostly great cars. They're certainly not Toyotas, but no one else is either. If we go back to these tariffs, we're going to really hurt the car industry in this country. We may actually kill it. That's a pretty big statement, but with the transition to electric vehicles happening at the same time, there's a fairly good shot that we would literally kill the domestic car industry. Markets hate uncertainty. When firms can't plan because the rules keep changing, what do? They don't plan. They stop. And we're already seeing domestically a massive slowdown in economic activity that is based on long-term planning. Companies naturally are waiting for the dust to settle. So let's get back to stock markets. What is a stock? If it is the discounted net present value of a future stream of income. In English, if future earnings are expected to fall, and certainly that's likely in a world of a global slowdown due to tariffs, then the underlying valuation of those companies will fall also. So by any objective measure, the stock market likely has further to drop. Now here's the rub. The market can stay wrong for an awful long time. Timing markets is no easier just because we know we have some of these challenging policies in place. Also, the markets have been overvalued because of the Magnificent Seven. Well, I've talked about those for over a year, and this last month we've seen the Magnificent Seven fall to earth pretty rapidly. Tesla's drop has been quite spectacular. But the rest of the economy should expect reduced returns, and therefore reduced investment returns, regardless of being stocks, bonds, or other. When we get into timing these markets, though, it gets difficult for two reasons. We've already talked about how markets can stay wrong a long time. The second reason is, where are you going to put the money? Arguably, all the asset classes are going to get hurt. Our short-term fixed income and international exposure has really saved our clients in the last couple of months from the full brunt of the pain that the markets have received. A number of our clients will notice that we've been rebalancing quite a bit during this correction, and that makes sense. Valuations have changed significantly. The huge problem, though, as an investor, is if you take a 20-year period and you pull out the 10 highest gain days, not weeks, not months, 10 days in a 20-year period, you will reduce your stock market returns by 50%. Nobody is that good a timer. And if you reduce stock market gains by 50%, you don't reduce the risk that goes with those gains. You might as well not invest in the market at all. Well, we're not advocating not investing in the market. We're saying we're in for a bit of a ride here, and you're going to have to hang on. It's a period that's going to require discipline, dare I say hand-holding, and certainly coaching. We're here for you. We're here to make sure that bad decisions are not made under the stress and duress of bad news on TV. We wish you the best of investment success. Thank you.